Hello, 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 and welcome back to another enlightening and amazing episode of Wealthish Talks. I am your host, Rickdrieka Bennett, your marketing and business strategist. And today I am thrilled for our special guest of the hour. Today, our special guest brings us with over 40 years of experience in investment management to the table. So, everyone, please join in to welcome Steve Singlet. Singlet. Steve, thank you for being a part of our platform and show.
Well, Ricky, thank you for having me on your show.
You're welcome, and I'm just excited to have you because I definitely know as business owners, many people struggle with the investment part of business and the financial part of business many times, and it's a key for actually business growth. Um so I would say that your background is really spectacular. And when I look at the journey of investment management and how you've basically made it span for over 4 decades, and
Yeah.
you're still doing it now, and coaching individuals about being income independent. Can you kind of share a little bit more about that, or in your background about it, and how you kind of got inspired to focus on coaching as
Wow.
well?
The well, my my career in coaching is now just almost a year.
Okay.
As and what led up to it was a career that has spanned 4 decades. Yeah, I started coaching. I started investing when I was 25.
Hmm.
I started coaching when I was 34.
Oh,
So I
wow.
went from running my just investing my own money while I was still working for a company in New York City,
Okay.
um, and doing my own thing and learning about investing and trying to understand the markets and how the market reacts to things like economic change and recessions and rallies and the difference between that and how it reacts to interest rate changes and things. And even with the best companies in the world, and I was fortunate that my portfolio started off with what would now be considered all blue chip stocks,
Hmm.
um, and all dividend paying blue chip stocks as well.
Oh, wow.
So I started with a cash flow and a sizable amount not to lose. So my main objective was, make this thing grow. Do not take ex- extra risks with it so that you lose it. So I tried to find the most productive while being safe approach I could. But that also involved understanding what goes on in the markets. Like I was saying, the market cycle
Hmm.
and the cycles of individual sectors. Like sometimes you hear about the healthcare industry booming because of a new drug was discovered, or you hear about it going down because they had complications develop because of one of their things like that. And oil is an easy one to think about of how the prices of oil companies have fluctuated over the years. Um, so looking at all those charts and tables and individual situations that tell you, you could see many, many opportunities to sell securities at a profit, patiently wait, buy them again some other time, and do it
Hmm.
again and again and again. So I started um, doing that, trading, if you will, and reinvesting. And while I while I took profits, I put away 35% of the profits into things like municipal bonds,
Okay.
tax free bonds, or corporate bonds, or eventually I got into Ginnie Mae trusts where they'd pay out the mortgage and the principals to you. And by the time I was by the time I was 34, 9 years later, I was making about 5 times my salary in my investment in investment income.
Oh wow.
So I put myself in a position to say goodbye. I'll take, and I was there just long enough to vest in the pension plan. That was one of my objectives. They've been putting away money for me, and I'm going to make sure I'm there 12 years before I quit. 12 years came along, and I was already setting up my own business. My corporation was incorporated about 3 months before I actually left the company. I had two of my close friends who were ready to come on as my first two clients. All I had to do was take a bunch of tests to get qualified to become an RIA, a registered investment advisor. So I was a registered investment advisor. I had less than $1 million under management in '79, and I sold my company last year for more than 100 times that. For
Oh wow.
about 100. It was 100. No. My company had grown to the 110 million. I sold my company. I did not sell it for 110 million. That came out wrong. I wish I had. Probably I'd be on a yacht somewhere and not talking with you, so that would have been a problem. Anyway, so I did make some significant bucks, but doing that, I wrote a book about it. The book is over my shoulder there, Retirement Money Secrets, of how basically you can manage your way, how you can have a business going on and make sure you put aside enough money so that when you stop that business, you can afford to do whatever you want to do because you got other income. I don't need that money from the management I was doing because I had enough put aside that the income, pretty much kept going and maintaining the same lifestyle. So that's what I think a business person should have an eye on. As you're growing your business, if it's your own business or if you're working for somebody else, put a little bit away. Start growing that. Have something on the side that grows your income for you. So at one point or another, you can say, all right, I've been doing this long enough. I can do something else. I got an idea here. I'm going to start my own thing. You'll be able to fund it. Like I had enough that in the financial services industry, I don't know if you've spoken to people about when they get bought out, they don't pay it to you all at once. You don't
Right.
get,
It's over a period of time.
right, you don't get it all at once. So I got maybe just a hair over half of what I was going to get.
Hmm.
But even with that, with that and what I already had, it generated as much income as I was getting in my management fees.
Oh wow.
So I could wait patiently for this year for 6 weeks from now when the rest of the money is supposed to hit my account. So that's, so if there's any lesson from that story, I want to be in that position when I sell my business, whatever business that is, that if somebody's listening, you want to be in a position, if you can sell your business, fine, but you want to be able to replace the income. Some people get into businesses or to positions where they can't sell it really, or they're employees, and they really don't have something to sell. So whatever that situation is, as you're getting older, as you go, I started my business when I was 34. Some of you people out there might be at that age right now, and trying to get that accomplished. Putting aside money and managing it with an income focus will get you there more quickly than speculating on finding the next Amazon or Microsoft or company like that, or Nvidia. When new businesses go public, you don't know which ones are going to succeed and which ones aren't. And you really want to focus more on which ones of those successful companies want to pay you for the privilege of having you invest in their company.
You just said a lot. So I really want to unpack a lot of the stuff that you kind of covered
Okay.
in your background because I feel like though you dropped a lot of different nuggets for the audience. The first is for those who don't really know about investments. Can you explain what blue chip stocks are, or what
Sure.
in more simplified form? Because I know there are people who be like, "Huh, what?"
Well, stocks, you know, if you think of all the companies you know of, like you go to Walmart,
Hmm.
um, you shop at Target, okay, you buy gas from Exxon,
Right.
right? All those big name multinational companies that we all know and love so much. That's really the successful ones. The blue
Hmm.
chip, they're called blue chip because they're there. They've been there forever and
Right.
expect to continue. Uh, it's not always that simple. You've heard of Sears Roebuck, right?
Hmm.
Okay, that used to be a blue chip company. I don't even know if they even exist a whole lot anymore. They might just be a catalog store. I don't know.
I
But
think they're just catalog. I don't think
yeah,
they're
but so
because they
there's
sold a lot of their
I I
actual
re, I
stores.
remember one. In fact, my wife worked at it for uh, uh, one of their locations out in New Jersey when I was working in New York. It was a big skyscraper with their name on it, and they were one of those blue chip companies, and they finally went under.
Yeah, because Kmart was one at one point.
Yeah. Okay. There's another one. So anyway, but the top notch, the big companies will pay dividends. And there used to be the Standard and Poor's used to rate companies on fundamentals as opposed to, I'm getting too technical, fundamental issues like, are they profitable?
Mhm.
Do they not have a lot of debt? Do they pay dividends? Those types of things.
Yeah.
And I only used to invest in things that were rated B plus or better. So
Okay.
I'd limit. So you limit your risk by going into companies that are well established, well known, don't have a lot of surprises. You know, a lot of people these days say they're investing in dividend stocks, and
Mhm.
and dividend stocks have categories like kings and three different categories, I think, of different levels of how many years in a row they've raised their dividends.
Yeah.
You know,
Because I know
that's
with
some
dividend stocks, I have Verizon and then I also have Target, and they definitely pay a dividend out as it relates to stocks.
right,
And they have
and
a
that's
good dividend.
it's a piece of their profits.
Hmm.
It's a piece of their profits. So what I do is I invest in a type of funds that own those companies. You know,
Okay.
it's just like a mutual fund or an ETF owns
Hmm.
many companies inside. A closed-end fund is a trust entity that owns those same securities. The difference being that their purpose, well, first of all, they're called a pass-through trust. They
Right.
don't pay any taxes on the income they receive, and in order to do that, they have to pass through to their shareholders 95% of what they make. So think if Amazon had to pass through 95%
Hmm.
of its profits to those of us who own some shares of their stock. Um, they don't. But these things have to. So these entities, these pass through trusts called closed end funds, they'll purchase two or 300 stocks. They'll own Amazon, Microsoft, NVIDIA, the healthcare sector, the energy, all these companies, and they'll own them. And when they get dividends and stuff like that, or they take profits by selling them, the profits, 95% all go back to their shareholders. So they're there to produce income. They're not there to produce that wonderful growth in market value that makes you feel good, but doesn't pay the bills. You know,
Right.
you could have $10,000 6 months ago, and then with this market rally, you now have $17,000, but the dividends that you're getting are the same.
Right.
Unless you sell it, it's not going to buy you a car or anything. The the top of the book, on the cover, it says, market value fuels the ego, income fuels the yacht.
Mm.
So in other words, if you have companies that pay you income and you also have enough choices that you can sell them profitably periodically, you develop two streams of income, and those two streams of income can be reinvested or spent without any detriment to the overall net capital that you have. It's almost like a monopoly board.
Okay. So, so I know that you basically was your whole portfolio basically invest in those pass through trusts, or were you independently like investing in stocks and things outside of that as well?
I grew up with those. I had 30 or 40 stocks in my original portfolio, and
Okay.
I traded stocks up until maybe 2000, almost exclusively
Okay.
around 2000, around the time of the dot-com bubble and a little bit beyond that. Okay, but the dot-com bubble didn't affect me because I've never bought a stock that didn't pay a dividend, and the NASDAQ is the one that crashed. The tech sector crashed, and I never owned any of those anyway. I never had mutual funds or tech stocks and stuff because they didn't pay dividends, So I actually had a good time during that crash. But but that's the thing. I had a lot of stocks and I traded them. But up through the financial crisis, when the interest rates started to go down, the market just kept going up. I mean, it was like a 12-year rally, basically, from 2008 to 2020. And it got to the point where there wasn't anything that was down. I used to buy them when they went down 20%.
Hmm.
And sell them if they were up 10%. It was that simple. And there were about 130 of them that met all my requirements, the dividend paying, the profitability, and all that stuff. And they weren't too overpriced. I never liked anything that was over $100 a share.
So, okay. So for our audience, could you one
Did I go too
for
far?
getting started,
Oh,
could
okay.
you one what would be the recommended amount for them to actually start investing if they had to start today? And two, what would be the process of actually researching stocks so that they can understand it? Because a lot of people try to invest in things that they don't understand, which is a no-no. And with
Right.
investment, you should always do research. So what would be the
Absolutely.
process that you tell them, and what would be the starting amount?
Yeah. Okay. Well, the starting amount really can be almost anything.
Right.
Really. I mean, if you can put a few $100 away every week or even every month, you're going to get to the point where you can buy one of these trusts, okay? And these trusts can be looked at for quality and diversification and income production, just like a regular stock can, but it's much cheaper and it's immediately diversified. One of the things you want to make sure of when you're starting out is you don't want to put too much money in one thing,
Hmm.
particularly one company. It's like saying, okay, my brother-in-law just started a pizza parlor. I'm going to invest in the pizza parlor. An unknown entity, really. You're going to
Right.
hope your brother-in-law is successful. So it's the same thing if you're going to the stock market. Which one of these things am I going to buy? Am I going to listen to this talk show host and he's talking about this new issue? Am I going to look at the news and they're ringing the bell because this guy just went public? Is that what I'm going to do? Am I going to listen to the spiel about the technology and say, okay, this one's going to be the next Amazon and put my money there? Like you said, you got to do your research. And like I was saying before, I used to look at companies. I used to look inside and see if they were profitable. How long have they been in business? You know, uh, are they cutting a profit? How much debt do they have compared to their equity? To their value of their business. You know,
Hmm.
um, things like that. What kind of industry are they selling buggy whips about the turn of the century, or are they into the new things? Or are they still, um, you know, whatever, or is it something that's going out of business or something that's just getting started? So all those things are part of the research, but the other research goes beyond that. The other research involves buying a book that tells you that when you own a stock, you own ownership interest in that company. Okay. And if that company goes under or doesn't succeed, you can lose every penny you put into it. If you, on the other hand, loan your money by buying a bond or a preferred stock to that company, buying a bond or buying their preferred stock, you're actually loaning them money and getting a rate back. If they have serious trouble and go bankrupt, the shareholders are going to get nothing, but the bondholders might get a few pennies on the dollar or even 75% on the dollar. But they're going to get something while the other guys aren't going to get anything. So in every situation, as a new investor, income purpose securities like bonds, preferred stocks, mortgages, real estate type investing for income is always less risky than owning an ownership interest in a company. Always less risky.
I love investing in REITs
Oh yeah.
from the real estate perspective because
Uh-huh.
you're owning some commercial real estate and making money off of it.
Right.
Um, but there are also a lot of different companies out there that you can build your portfolio with. And I personally like Fidelity. um,
Oh,
but
your that's where your accounts are.
mhm,
Yeah, I do too. I'm with Fidelity. And but back to what you were saying about REITs. REITs have a problem with taxes. Sometimes the way and REITs and master limited partnerships have tax implications that you don't want to get involved in if you want to get your taxes paid on time. So what I do is I use these closed-end funds. Any type of investment you think of, there's a closed-end fund for that. Like you always say, well, there's an app for that.
mhm,
Anything you want to do, there's an app for that. Well, there's a closed-end fund for that. There are closed-end funds that do real estate investing, including REITs. There are closed-end funds that do, I don't know if you're familiar with BDCs. I'm assuming you are. You seem to know everything. So BDCs are business development corporations. I find them a little bit more risky, but if I can buy 30 different companies in the form of a closed-end fund, then that mitigates the risk a little bit. And I can tell people who I'm coaching, unless you got 7 figures, you don't want to mess around with them. And here's the way I would do it. So yeah, you gotta do your homework. You gotta know there are 4 ways to minimize risk when you're investing in any kind of investment.
okay,
Okay, find a way to determine the quality of the investment, like we just talked about: profitability, how many years in business, how diversified is their market, things like that.
mhm,
So you got quality, and diversification is a second element for your portfolio. Not only do you want the company to have a diversified thing, but you're going to make sure your investments are diversified. If you've got $10,000, you don't want to buy one position, you want to buy 10 positions.
right.
If you got $5,000, 5 positions. You know what I mean? That type of thing. Closed-end funds are great for that because their prices are much lower than stocks and they're more diverse. You're buying hundreds of positions. So that's the 2 of them. The third one to minimize risk is income production. I've never ever bought a security that didn't pay me something. I've never bought a zero coupon bond back when they were the big deal. Oh, you got to get these things. They pay you all the money up there, 10 years from now. I like money up front. I want it this year. A dollar today is worth more than a dollar 10 years from now.
That
Right?
is true.
Right. So income, everything's got to produce some income. And depending on your age, you might want them to say, like I do, I don't buy anything in a closed-end fund that's not paying me at least 6%. These days, the average in my portfolios is between 9 and 10%
Mhm.
because of the spike we've had recently in interest rates. So the last the one of the last four is profit taking. When you do get lucky and the one you buy goes up, make sure you have a target of when you're going to take a profit. Because if you look back historically at any market average, it's never straight up. And if you look at the chart for any individual stock ever, it's not straight up. It may be an upward trend, but there's always going to be a lot of this.
Yeah, it was choppy.
It's choppy, it's volatile, it's what's the favorite word? There's not much certainty. There's never certainty. Certainty doesn't exist. I mean, think about it. Planes can fly into buildings. It'll knock the market on its butt for months. You get a COVID epidemic. The market goes down 40% in the space of 2 months and then right back up in another 2 months. It's not predictable. But if you do those four things I told you about, you only invest in quality, you diversify properly, you have income coming in, and you've taken your profits, none of that's going to have a big negative effect on you because you'll have pretty much anticipated the changes as they come along. So there's a lot of basics to investing, and really, I would recommend to any person who's just starting out to do some homework. Really learn a little bit. If you didn't take any economics courses in college, go get an economics book and just
Mhm.
understand the market cycle. When they tell you it's going to be a recession, you don't have to panic and get worried and stock up on groceries. It's the meaning is all it means is that 3 quarters in a row the gross national product for the whole country didn't go up. It's not a big deal at that point. When it becomes a depression, that's another thing. But
Yeah.
we're pretty much protected from stuff like that.
I think you unpacked a lot and it was amazing. And I really feel like the way you unpacked that, you probably unpacked a lot of this content in your second book, Retirement Money Secrets. So
It's in there.
could you kind of give us a brief overview of the key principles or that you have shared in your second book?
Sure. Four of them was those what I call QDI plus PT, quality diversification, income, and profit taking. But there are
Okay.
two other important ones, and the one we sort of touched on was that everything is cyclical. The market cycles,
Mhm.
individual sectors like healthcare, energy, retail, services, they'll vary. They'll go up and down, up and down. And they all don't go up and down in the same direction all the time. So you got to be aware that all these cycles exist, and don't be a denier. Just because the market just went up to an all-time high. In
Mhm.
fact, yesterday the S&P it increased its all-time high by about $2, something like that. Uh, it doesn't. There's no assurance that's going to continue. I mean,
Right.
it's good, and we don't know when. So we have to alter how we buy or when we sell by knowing that there's this cycle. You might want to raise your target profits in an overall market rally, but you
Mhm.
still want to take those profits. I get to the point where instead of selling everything when I got 5%, if I see everything is up 5%, then I'm going to change it to 7%, you know, but not going to let anything over 7% go by me. I'm going to take it. And I'll always be taking, and I always, even today when I don't have all that many profits, and I don't want to muddy the waters, but when you invest for income like I do, you're more prone to what's going on with interest rates than with the stock market.
Mhm.
Okay, because that's what impacts your prices. But you always, so like when the market's going up a lot, I'll buy less of something, but I'll still buy it if it's yielding an acceptable rate over 6%. I'll still buy it. I just won't buy as much of it because I know there's a good chance the market will go down, and I'll then be able to add to that position at a lower price. So that's how you deal with that market cycle. And the other thing is to really get yourself focused. Where am I going with this investment idea? What am I trying to accomplish here? What Steve was trying to accomplish back in the 70s, he wanted to get to the position where he had enough money coming in that he didn't have to get up at 5 in the morning, catch a bus for New York City. Regardless of the weather, we used to have real winters then in New Jersey where you sometimes coming home or going there, you couldn't get to New York City. You'd be stranded in a bus for 6 hours. So that I didn't have to do that anymore. And I could pretty much sit around at home and make phone calls and trade the stock market and get people to come on with me as a business because I had the income. I didn't need to go there anymore. So what was I focused on? I was focused on income. I needed income. I didn't care what the market value of my portfolio was because that wasn't going to pay my bills. That wasn't going to keep my wife in the level of clothing and out to dinners that she wanted. It was not going to do anything for that. I had to have income. So that's why I focused on income. And I think if everybody starts off with that focus for income, then they might get to a stage where, okay, I got a lot of income now. Now I can afford to maybe speculate. I'll buy something that is up and coming, or I'll put a few bucks in something a little bit more speculative than my regular portfolio. And then for a while I'll go like that. And then as they get closer to their 50s and 60s, they'll have to say again, now I got to focus on income again because pretty soon I'm going to get rid of that job and I'm going to have money again, more money. I mean, I talked to a guy this morning who's retired, and he had in his portfolio more than 70% of it was still in stock market type securities that were right now at their highest level in years and years. He had all these profits, but the portfolio is only generating about that part of the portfolio is only generating about 1 or 2% income.
Oh, wow.
So we talked about, well, if you move that to a 9% income generation mix of securities, think how much more, you'd have 5 times the income that portfolio is now producing. Add that to the pension you're getting from work and a little bit of Social Security that you have. And instead of just sitting home, you're going to be able, to go up into the mountains and do some fishing, because you have more income. You'll be able to do more things. So that's the type of mindset that you have to have. When you're really wealthy, you get to the point where you say, I really don't have to speculate at all anymore because I got enough. But when you say, then you get to some point in time where you say, I'm doing all right. I've got some income and I can afford to lose a little bit if I, if I don't hit the jackpot, to use gambling terms, so I'll take a risk. And the best thing that can happen is that you lose money when you take that risk. You know why? You learn a lesson. You learn a lesson. And when you learn a lesson that you can get wiped out just like that in the stock market, then you learn, I'm going to go back to those principles we were talking about. We're going to make sure I got quality and income and diversification going on. But if you do that, I don't care when you start or how little you have to start with. If you use the proper vehicles, and for many people that could be mutual funds or ETFs too, because there are those that pay income, but make sure they pay income. I use closed-end funds because they have the same securities, they trade like stocks, and they pay on average more than twice the income of the other two. So that's the story.
I love your unique perspective. One of the things that I have noticed when it comes to investing and then doing research is when I go look for books on investment, to just stay on top of like what's going on or what's changing. Many of the writers of these books don't have a background in investment or don't have a lot of years in investment. So I really um, love the fact that you have over 40 years of a subject that you're writing about. So can
Yeah,
you kind of briefly let us know like how your direct management experience kind of shaped your approach to your investment strategies?
I think yeah, I can. So I was managing money for 100 between 130 and 150 families basically throughout the country and some overseas, and amounts ranging from less than $100,000 to 5 and 6 million. So I was managing with all sizes and kinds of portfolios, and you'd be surprised how similar the needs and objectives are, you know,
Hmm.
uh, at different, at different levels, but the same type of thing. They all wanted to have this financial freedom type of thing where they could do what they wanted to do. Now, in some people's case, they wanted to travel the world. In other people's case, they just wanted to be able to hang out with their grandkids, and not have to work anymore and stuff like that. But they all recognized the fact that it was the income that was actually paying the bills. And
Hmm.
I was able to get them to focus on that instead of um, chasing the market value. And I remember around goes back to the dot-com bubble back in the 2000, just at the turn of the century, when the Nasdaq market was climbing so greatly um, with even the radio commentators used to talk about the no value rally. You know, none of these companies were making any money. Not any of them were profitable, but people were just throwing money at them. And the few that survived have survived very well. But it was a very few in percentage that actually uh, came through as superstars like the ones we spoke about before. So it's if if you set your goals properly and protect yourself from extreme loss, you're not going to lose anything when the market crashes because you're going to have those blue chip companies that we spoke about at the onset, the Walmarts, the Targets, the Exxons, and things like that, that have been through financial difficulties in the past and have always managed to come through. And you're not going to have the ones that, oh my God, we're in a recession now. Nobody's going to be buying these products, and we haven't made any money yet, so we're just going to have to fire employees, and eventually the spiral goes down and down. That's not going to happen to the big established companies, the ones that are paying you dividends. They're going to be okay. So,
Yeah.
so that's really the secret of it, is to manage your risk early and throughout your career as an investor. Um, Spread it around to many different types of investments. So I like to think of diversification. Most people think of it as a defense against risk, and that's probably what most people should think of it like. But when you get to the point where you can have a large portfolio, I make I make diversification an offensive weapon. Like I've got all superstar jump shooters on my team, and I can just any place I can get a profit. What if anything goes up anywhere, I'm going to own it because I own all these closed-end funds that own
Mhm.
hundreds of securities, and I'm going to benefit. And that's where you want to get to the point where you benefit when the market goes up without really lifting a finger, and you don't get hurt when the market goes down because you still have all this income coming in, so you can take advantage of those lower prices.
Awesome. So, looking because you really gave us a wealth of knowledge, and I love it. What are some future goals and incentives that you have for like your coaching practice and like potential projects that you'll be releasing in the future that can inspire those who want to invest?
Okay. I'm
Mhm.
my goals in life right now, really, and I don't want to make it sound like I'm not interested in. I am still interested in the money I'm making from my coaching efforts because not from so much need, but just it's what I do, But I want to get this information in the hands of as many people as possible because if you what I just told you about closed end funds, if you or any of your listeners were to call a broker or their broker right now and ask them about closed end funds, even though closed end funds have been around far longer than mutual funds or ETFs, most brokers won't even know they exist. Most financial advisors will steer you away from them and not toward them.
Okay.
And what I want to get people to do is know that they exist and insist that their financial advisors use them to help them develop an income productive portfolio. And eventually, those advisors are going to have to do it. Right now, they'll put most people, particularly small portfolios, they'll put them in model portfolios that, oh, these things are made for somebody like you. You'll own everything, just like I was talking about. Sometimes you'll own fractional shares, less than one share, but you'll own Berkshire Hathaway. You'll, you know what I mean? But you know, not that it'll ever make a difference. But they never ever talk about the income that you're going to generate. And the reason for that, and I know this because I was one of them. I used to get paid on the market value of the securities that I managed.
Okay.
So in a strong market or when interest rates were way down and the prices went up, my fees would be higher. But I'd be taking profits. And I always told my clients that I'm going to make more for you in profits than you're going to pay me in fees. And I'm going to do that every year where it's possible. And most years it was easy. 2021, we made for our clients 4 years worth of fees in profits alone.
Oh,
You know,
wow.
well, that was a big year. So that's what I used to tell them. They have no regular advisors have no clue about that. They never take profits. But the reason for that. There's several reasons for that, but they rarely take profits and they rarely mention income. If you were to go to the quote screen in a lot of places and you look up the quote and you put in Exxon on that first quote screen, you wouldn't see what their yield is. If you went in Fidelity, you go to their quote screen and you plug in any security, you're going to have to page to the next quote screen to find out what the dividend yield is. To my mind, that's the most important thing in the world. When I get my statement at the end of the month, I look at the income I received,
Mhm.
and then I'll look back to 3 months earlier, and I'll see, okay, that income's higher than it was 3 months earlier.
Okay.
That's what I want to see. Okay, most people and most brokers will look at the bottom line market value, and they'll talk to you in terms of total return. And the reason they started talking about total return is so that they could use the same benchmark for both equities and closed end, or rather not closed end, but equities and income securities like bonds and mortgages. And there's no relationship between the two. They're both impacted by different economic scenarios. I don't know. So you got to be careful. But I think education is important. I try to put a lot of the book, even the glossary of terms in that book will teach somebody something that they don't know right now.
Awesome. Well, Steve, thank you for sharing your wealth of knowledge and your insights today with our audience. And it has been truly a pleasure and an honor having you on Wealthish Talks on today as well. And to all of our amazing and wonderful listeners, thank you for tuning in to another episode of Wealthish Talks. Remember, wealth is not just for the financial side of things, which but it is an important part of it. And also remember that wealth is about your habits that we cultivate and using positive changes as we live our lives. So until next time, make sure you're embracing your purpose, your passion, and your power on this entrepreneur journey.